So we were just talking about the big declines this week in the markets, and how my point is it's August. It's the B team trading on Wall Street. That's what I would be doing when I was younger. In August, it'd be like I'd be the main dude, and so you don't want a dude like me running things. But the economy's in good shape, so I say, keep investing. The biggest risk, I think, is a self-fulfilling prophecy risk, where markets, especially bond markets, will start to force the hand of the government. They'll force the hand of, especially the Federal Reserve, to lower interest rates further, and they'll force the hand of the government to just give stimulus in some sort of way. But overall, my thing is keep investing. It's not necessarily a normal quote-unquote market. There's a lot of government activity that can impact this. So that's my take on that.
Yeah.
Yeah, Josh and I are in the business of kind of hedging, on a little bit of this, and what we found is there are a lot of folks that share like the anxiety of what the market's going to be like, as volatile as they were. And you've seen what happened with GE as well, with that stock fall off after the quote unquote accounting fraud was exposed this week.
Yeah, that dude Harry Markopolos, the dude that uncovered Bernie Madoff. That dude wrote a big old 100-page paper on saying how GE is a bigger fraud than Enron and WorldCom.
Yeah, wow. Combined.
Yeah, crazy, right?
Yeah,
I think. No, go ahead, Mike.
No. Look, I think what's fascinating to us, there's a lot of volatility out there right now.
Right,
and I think there's a lot of capital out there, right? That's creating the volatility. There's low interest rates. We've been in a low interest rate environment for, over a decade now. And it just lowered interest rates even more. And the economy's doing, as you mentioned, very well. And we are cautiously optimistic that will continue. With that amount of capital flowing into the markets, you're starting to see more volatility. But not just that, we foresee more inflation. And what does that mean? You're starting to see prices of things go up and wages not necessarily going up in the same fashion. Mm-hmm. So you're starting to see home prices go up, and yet salaries are not going up in the same rate of change. And you can go into the math, and it's probably not appropriate for this call, but the second derivative and just those correlations we're seeing that. And so we're investing to hedge that, as Lane mentioned, in real estate, in something tangible that will increase your dollars in line, or if not greater, than the other increases of those supplies, if that makes sense. We get tons of questions, and maybe this is a long-winded answer, but when's the next recession, and when right. People are thinking this is just going to end, it's just going to end. And I think everyone has that same mentality of, we've seen it happen. It's going to happen again. And we can't predict it, and who knows who could. But we're certainly seeing pockets already of distress. It's not happening in the same way.
Right.
And I think that's going to continue. So
we get a recession on average, the last 100 years in America, we get a recession on average every 7 years. Mm-hmm. And it's been 10 years now that we haven't had a recession. So just from a statistical perspective, we're due. But that's no guarantee that we get a recession. There's a lot of things that have to line up for us to get a recession. Actually, let's take a moment, Josh. Go ahead, Lane. Go ahead, Josh. I'm sorry.
No, I was just saying, using your statistical analysis in historically thinking, every 7 years. But again, there hasn't been that much capital in the markets flowing in the history of those statistics to show that. So we're in a new game. This is a new, world, if you will.
Right.
And not to say that this is something different. Eventually, there's going to be a correction. It's just a matter of the terms of the game have changed, or shifted, if you will. Shifted is probably better to say. Yeah.